Good morning, it's Monday the 1st of November and welcome to Atlantic Capital Markets roundup of the coming week's economic highlights to keep an eye out for. As always, we'll give you a quick summary of the macro data points from around the world to expect over the week, and we'll then take a look in more detail at some of the bigger stories straight afterwards. So stay tuned. So let's take a look at the economic numbers being issued this week. And starting today, we have the latest German retail sales figures, the final Purchasing Managers Index in both the UK and the US, and also in the US the ISM manufacturing PMIs. On Tuesday, we'll get the latest interest rate decision in Australia and the final manufacturing PMIs in the Eurozone. On Wednesday, we'll hear the latest Chinese Caixin Services PMIs, the UK Services PMI, the ADP's employment data figures, US factory orders, and the US ISM non-manufacturing PMIs, the EIA crude oil stockpiles, and will they, won't they, a big day in the US as we hear the latest interest rate decision from the Fed, and we'll talk more about that in a moment. On Thursday, the Eurozone Services and Composite PMIs, the US jobless claims, and again, will they, won't they, here in the UK as the Bank of England also makes their monthly interest rate decision. And that's something we'll also talk more about in a moment. And on Friday, the Eurozone retail sales figures, the Canada employment change, and the US non-farm payroll, which again we'll discuss afterwards. And the companies that we'll hear updates from this week are as follows. On Monday, we'll hear from Ryanair. On Tuesday, the oil major BP, whom we'll discuss shortly, Flutter Entertainment, Standard Chartered, and in the US, AMC Holdings and Lyft, and Pfizer. On Wednesday, we'll hear from the retailer Next, and we'll talk more about them in a moment. Coca-Cola HBC, Trainline, and Morgan Sindall. On Thursday, it's the turn of Aston Martin, BT Group, Deutsche Post, Wizz Air, Peloton, Sainsbury, and Uber. And we'll talk more about these latter two also in a moment. And finally on Friday, International Consolidated Airlines. And again, we'll talk more about them in more detail in a moment, so do stay tuned. So last week, central banks and earnings dominated. The Bank of Canada surprised the markets by ending its bond buying programme early. However, the European Central Bank remained in wait-and-see mode despite surging inflation. And this week, it's the turn of the central banks of Australia, the UK and the US, who are now under the spotlight. Meanwhile, in chilly Glasgow, world leaders will be meeting at COP26. And OPEC Plus will also be meeting this week in light of the energy crisis and multi-year oil price. Will the oil cartel up their output further? Brexit developments are also worth keeping an eye on as headlines go from bad to worse. So let's take a look at some of these key stories of the week in detail. On Tuesday, BP is due to report its Q3 earnings. Now, the strong rise in oil prices should boost BP's results, helping to offset production declines as the energy giant transitions towards greener energy. Reducing debt has been a key part of this plan, and BP has made solid progress here. Net debt was $42.7 billion, down from $43.3 billion in the previous quarter. And with natural gas prices also surging across the year and more sharply across the quarter, a windfall profit of around $500 million is expected from the company's natural gas trading business. Dividends will be another area of focus. Now, management have pledged 5.25 cents per share quarterly dividend. They also use funds from a disposal to fund a $1.4 billion share buyback program. The firm also said that whilst oil remained over $60 a barrel, BP intends to offer a 4% annual dividend hike and a $1 billion share buyback. On Wednesday, the retailer Next is expected to post Q3 results. Now, whilst the share price surged across 2020 as the COVID recovery took hold, the share price has been more range-bound across this year, albeit well above its pre-COVID levels. The retailer has performed well thanks in part to its sophisticated online offering and having picked up market share from failing competitors. Next has a tendency towards modest forecasts, helping it report better than expected sales for several consecutive quarters. Expectations for full price sales growth is in the region of 44% versus 2019. Full year profit before tax 2022 was already upgraded to $800 million. Analysts at UBS believe that it could come in closer to $820 million. So also on Wednesday, the Fed is widely expected to announce its first big step away from the ultra-loose monetary policy across the past 18 months towards normalisation. Now, the central bank is expected to start to taper its $120 billion a month bond purchases and to end the programme completely by mid-next year. Now, the meeting comes as inflation runs at a 30-year high. Core PCE, the Fed's preferred measure of inflation, jumped to 3.6% in September, well over the Fed's 2% target. Meanwhile, CPI has been running over 5%. Now that bond purchases are set to be wound down, it's what Fed Chair Powell says about inflation, which is the key, as this will drive interest rate rise expectations. Here, Fed Powell is likely to stress that the end of the bond buying scheme next year won't automatically mean a rate hike. So do keep an eye on the US dollar and US indices. When Sainsbury reports interim numbers on Thursday, they'll face a tough comparison from the previous year, when everything else was closed and going to the supermarket was actually the weekly highlight. The results come as inflation is driving up prices, but Sainsbury is trying to keep those price rises under control amidst a promise to improve its value position. Basically, margins, which were already thin, are likely to become yet thinner. There have been other headwinds, such as the petrol shortage, which could have forced shoppers to limit those supermarket visits. Online sales have been a strong point, improving again in the last quarter. Online sales could continue to creep higher, with some customers already buying their Christmas products. And Thursday also brings us the latest decision from the Bank of England. Now, the November interest rate announcement comes at a time when elevated inflation may not be as transitory as initially expected. In the last BOE meeting, policymakers voted unanimously to keep interest rates on their historic low levels. Michael Saunders was the only dissenter voting to taper the QE programme, but the other dissenter, ex-chief economist at the bank, had left his post before the meeting. Since then, Bank of England officials have adopted a more hawkish tone over recent weeks, particularly since the energy crisis ramped up, supply chain disruptions and labour market shortages lifted prices. Consumer prices rose to 3.2% year-on-year, ahead of the bank's target 2% level. According to the CME Group BOE Watch tool, an interest rate hike is 100% priced into the market, with a majority forecasting a 0.15% increase. So obviously, do keep an eye on the pound and the FTSE. And finally on Thursday, Uber is due to release Q3 earnings. Now, Q2 Uber had forecast that it would reach EBITDA by Q4 of 2021, and this quarter expectations are for an EBITDA loss of less than $100 million, another step closer towards profitability. The whisper number on the street is more optimistic still, with EBITDA expected to be a loss of less than $50 million as mobility picks up. According to Apptopia data, total Uber downloads surpassed pre-COVID levels and increased 14% year-on-year. Earnings per share are expected at minus 34 cents. And so on Friday, British Airways owner IAG is due to report Q3 results, which are expected to be better, but still pretty grim. Now, the numbers are likely to show a disappointing summer season. Not as bad as 2020, but still terrible in the grand scheme of things, as travel restrictions remained in place, in addition to complicated government measures. That said, the industry is also firmly on the road to recovery. There is, of course, the risk that with winter approaching and COVID cases expected to rise, that travel restrictions could well be reimposed in some countries. Surging oil prices are also likely to have been a headwind across the previous quarter. A net loss of around £618 million is expected, which is around half of what it was the same period a year earlier. Finally, on Friday, we'll hear the latest non-farm payroll numbers in the US. Now, the US Labour Department's job report has been weak over the past 2 months, coming in well below forecast with just 194,000 jobs added in September, down from 366,000 in August. However, the unemployment rate fell from 5.2% to 4.8% in September. Jobless claims have also been falling, hitting the lowest level since before COVID hit to 2.48 million, down from over 3 million in July. This jobs report will be too late to influence the Fed's decision in October, and there is another jobs report before the December meeting. Expectations are for 390,000 jobs to be added to October and the unemployment rate to slip to 4.8%. So keep an eye on the US dollar and, of course, US indices. So to wrap up, let's take a look at the dividends for this week. In the FTSE 100, it's the turn of Unilever. And in the FTSE 250, we'll hear from Balfour Beatty, Ashmore Group, Hilton Group, Contour Global, Edinburgh Investment Trust and GCP Infrastructure Trust. So that's what's coming up this week. Don't forget to join us on Friday morning for our usual rundown of the week's events with our own thoughts and analysis. Always hopefully keeping you one step ahead of the game. Also, if you're interested in the markets, don't forget to check out our app, which you can download from the App Store to your mobile phone, which gives you a whole host of useful functionality as an investor. And of course, why not subscribe to the channel to make sure you get alerted the moment our regular reports are uploaded, including, of course, our special market reports as they're released. So, until Friday, from all of us here at Atlantic Capital Markets, have yourself a great week.